Is this technical in nature, positioning, or do you see this as some serious concerns and a rethink of the economy?
Hi, sir. Thank you for having me. I think, as you heard Mike and Brian say, it's two things coming together. Concerns about global economic growth, and there's a couple of factors fueling that, and also technicals that were offside in a big way. And when these two things interact, you get this sort of sharp movements, and the longer they last, the more they spread, because you start getting contagion. You don't want to sell something that's down a lot already, so you start selling something else, and you create this contagion in markets. We've seen it over and over again. So it is technical, but there is a fundamental driver as well.
Let's talk about bonds. 10-year yield, 118. Fundamentally, does that make sense to you? We've been wondering for the last few weeks why there was such a bid for bonds when everyone was expecting yields to go up on inflation and higher growth. They've gone the other way, and now they're doing that even more sharply today. What does that tell you?
They have, and lower yields are no longer good for equity markets like they were for a long time. I think you've got some growth concerns, but if you want to understand the level of the 10-year, you have to talk about certain technical elements. We are seeing a lot more ALM, asset liability managers, try to immunize their liabilities. Why? Because their stock side has gone up a lot. So they're not so commercial in terms of sensitivity to yield levels. They just want to immunize. And the second element, of course, is foreign demand. So yes, there is some economic trigger, but to understand the levels at where we're at, below 120, you've also got to go to technical. Let's not forget, this Fed is committed to keep on buying 120 billion. So that is also reassuring people at these levels.
But Mohamed, the move a week or so ago that suddenly surprised everyone lower in yields, technicals there was a reasonably big argument. When it prolongs a week later and moves further, it's less clear that it is technicals. The international argument I totally get, though that doesn't have to necessarily be technical. I guess my added point to that is, what does it all mean for equities? Because you've been saying of late recently that lower yields doesn't necessarily mean better things for equities anymore.
Yeah, I warned against that. I warned on this in my FT article a couple of weeks ago. Look, in the old days, the narrative was as follows. The Fed is successful in keeping yields down. It will continue to keep yields down, and that's great for companies. The debt costs come down. They can refinance easily. They can engage in all sorts of financial engineering, particularly issue bonds and buy back stock. And of course, there's a lot of M&A activity, SPACs, whatever you want to call it. That is true as long as it's a stable situation. When it becomes unstable, and when you have both concerns about lower growth, and inflation, suddenly the bond market is no longer your best friend. And that's what we have seen evolve over the last few weeks. And I suspect that that's going to continue to be the case for a while.
Shepard Smith here. Thanks for watching CNBC on YouTube.